You are listening to the Innovators Behind Disruption, a podcast series brought to you by Evolve ETFs. The world is evolving. Your investments should too.
Hi, everyone, and welcome to our next episode of Innovators Behind Disruption. I'm joined by Robert Iorio from RBC Dominion Securities. Robert, thanks for joining us today.
Hey, Raj, thanks for having me. I'm really excited to be on your show.
Great. So maybe we can start at the top and you can provide everybody with a little bit of an introduction to yourself and your background and maybe a little bit about your practice as well.
Sure. Before I do that, let me start off by saying congrats on everything you've done in the last few years. I have to, I've been in awe of you and I've been following you closely. I've known Raj for a long time, for anybody who's listening, and so just seeing the progress of your company and what you guys have been able to do is incredible. So congrats first and foremost.
Thank you very much, Robert, and I reciprocate that because I've been following you too, and you've been able to build a fantastic practice, and I love the fact that you are embracing disruptive innovation within it. And I'm sure we're going to get to that in a few minutes.
I hope we are, and I hope we do. So I'll start with my background. So it's funny because I started in the industry out of school. I was recruited out of university, and I was recruited for a summer job. And then before I knew it, that summer job became a winter job, and that winter job became a full-time job, and that full-time job became my career. I've never worked for any other company. So it's, when I listen to like your previous guests, like an Anthony Iorio, and I listened to some of the stuff he's done.
No relation, by the way.
No relation. No relation
just
to
common
me,
last name.
Correct. And so
pretty much though, I'll tell you, everybody with the last name Lala is related to me.
Well, we may be related somewhere along the line, but no. So so basically I started in the .com era. So that's going to tell people how old I am, which I'm sad about. But so I started right when, I was recruited in 1998, 99. This is at the peak. And so and that era, obviously, it was excitement, kind of like what we're seeing now. There was an excitement about investing and disruption and the internet and the possibilities of the internet. And so I started my career right at that point, and then started portfolio managing 2-3 years later when everything had collapsed. So that's my background, and so we've been portfolio managing ever since with RBC Dominion Securities, and and so now I've a great team that I work with, and come full circle, and I'll talk about that in a second.
So before we talk about disruptive tech and disruptive innovation, and I'm curious as to what term you put onto that, before we talk about that, can you share with everyone how you're generally utilizing ETFs within your practice?
Yeah, so we are just to kind of go back, like we manage a fairly large book of assets, about $500 million in assets, and we do that for entrepreneurs and families, private families. So unlike your ETFs, which are public and everybody can see what's in them, ours are private. So nobody really knows unless we kind of tell them what's in it. So that we manage those discretionarily, which means that we have the same license as a mutual fund. The difference is we're doing for specific private clients, just to make that clear, because not everybody knows the difference. And so where we're using ETFs, and this is rule number one, is we know that we're not able to do everything. That has to be super clear right off the bat. So we know what we're good at, and we know what our skill set is, and we know what we're not good at. So what we're not good at is where we don't have a ton of research and we don't have expertise. So that would be in small caps. That would be in those areas. That would be in international areas where we don't have the same research. It would be in emerging markets. It would be in alternative assets. And it would be certainly in fixed income these days, because we just don't have the ability, we don't have the inventory to build really robust fixed income, right? And so I mentioned alternative assets. That's where we're seeing more and more of those ETFs being used, but that's where we're subbing out a lot of that. And by the way, it's increasing. It's not decreasing, it's increasing over time.
And so why don't we now pivot over to disruptive tech? By the way, what do you call it?
I just call it. I just. You know what? I call it. look, I mean, it's tech, it is what it is. And for me, it's just themes, it's growth themes, right? So we can talk about general kind of technology and how that's disrupting our lives, but we can also talk about what's really changing the way how we live. And by the way, it's not only technology, it's technology is enabling it, but it's the way companies are bringing things to us, content, how easy it is to use that content, right? The learning capabilities, all those things.
Right.
So I would describe it as, you know, really growth themes changing our lives. So generational, I've written about this in blogs. I call it generational kind of themes. So generation meaning it impacts a certain generation. That's about, you know, a 20-year time horizon. And so I'll stick with that generational theme. We'll use that for the podcast today.
Yeah. Okay. And so, I mean, we've heard this term thrown around quite a bit in terms of, you know, a lot of analysts, a lot of investors feel that most other investors are kind of overweight big tech and underweight growth or innovation, whatever you want to call it. Do you agree with that?
We don't see that. So if
Okay.
So you want proof of things? Maybe if you look institutionally, possibly, I'm not sure. If you look at it at the private client level, which by the way, there's a lot of money being managed for baby boomers at the private client level, every portfolio we get, we do an x-ray. This is the first thing we do. So somebody says, hey, you know, we'd like to work with you guys. We've heard you do great and you have good returns. We've heard you guys, you know, are doing planning intelligently versus static. So they get referred to us. Our clients are great. That's how we build our book, right? And so that's how we get new clients. And so we x-ray these portfolios and we'd say that's couldn't be furthest from the truth. So they're still overweight, especially Canadians for that matter, still overweight in traditional areas, in traditional consumer cyclicals, in energy and financials. That's what we're seeing. That is the typical kind of portfolio. Now, is that south of the border? Is that still happening? I don't know. I can tell you we see more and more big tech or established tech, as we like to call it, versus emerging, which would be what you're talking about. But I would say that it's still an underweight category.
So how are you talking to clients about technology in general as a portion of their portfolio? And maybe you can talk a little bit about, you know, the larger tech positions and then how you're introducing to them more disruptive technology investing.
So there's a few ways to look at this. So we've always been growth investors. That's, you know, I have to make that clear. We don't believe in a dividend strategy or a value strategy, or that's not our style. So our style has always been grow assets, because the most beautiful thing in the world is compound interest. And if you can create compound interest, you have families and that work with us that'll be much richer down the road. And that's what we do. It's what we do for ourselves, and it's what we do for our clients. It's what we believe. It's our why, essentially. So our belief is to make everybody, our clients and everybody around us, better investors by articulating that compound interest is the most beautiful thing in the world, right? Start with that. And so you start with the belief, and then of course the type of investments we're making are companies that are growing faster than normal, given that focus, right? It doesn't mean we're reckless. It just means we're looking for companies that can compound earnings faster, grow faster, revenue faster. And so that might mean anywhere from 10 to 30% versus traditionally, you know, 5 to 8%, let's say. And so with that comes obviously a bigger weighting in what we call established companies or established tech, because that's what's had that kind of growth for the last, you know, 10, 15 years. And obviously a more, you know, a larger weighting to emerging tech. And so there you would see things, kind of the themes that your company would specialize in, for example. And we'll get into that in a second. But to understand like that whole thing, it's really a market-driven decision. So right now, we believe we're in based on technical analysis, we believe we're in a bull market. It's a secular bull market, as they say. So yeah, you've heard about this, right? So this technical thing. So what is this? So there's bear markets and there's bull markets. Rob, make the differentiation, right? So the bear markets and the bull markets are similar in breadth and in characteristics, is that they last for a secular period of time, which is 16 to 18 years, right? Those are similar in characteristics. And right now we've, you know, as of 20, call it 15, some people say 13, 16, it all depends. We've gone into a bull market phase from a bear market phase, okay? And now, so that bull market is essentially similar to all the other bull markets, which people say are inflationary, you know, the bear markets are deflationary. I think it's more than inflation. I think it's all about technological advancement. Okay, and so the new bull market we're in, just like in the 80s. In the 80s, it was computers. It was and by the way, you could say there was inflation. There was more inflation in the 70s than the 80s. Okay,
of course.
so computers actually deflated. So you didn't need as many people to do things, right? And so we communicated. We learned how to use email in the 90s, right? And then of course later part of the 90s, we had the information highway, which was the internet, right? And that changed everything. So in the 50s and 60s, that was the first bull market of our century, and that was industrial tech. So it was companies like General Motors, GE, Coca-Cola. They were using production lines. You know, they're using automation back then. So it wasn't something that humans had at their fingertips in their homes like in the 80s, but it was relevant in industrial. Let's fast forward to today. We're in a bull market today. The technicals are saying that. What is leading this bull market? Let's think about this. It's mobility. It's cloud. It's essentially it's tech. So we can broad strokes, you can say it's tech, but it's so, you know, it's the way we communicate. Think about social media. Think about the way we consume content, streaming. Let's talk about autonomous driving. Let's talk about green tech, right? Let's talk about sustainable transport. Let's talk about so I said content. We could put gaming in there, right? You can put the way we communicate. Look at the way we're doing this right now. We're looking at each other. We're taping this, right? This would have been impossible, you know, 15 years ago. This would have happened over the 10 years ago. Would happen over the phone. And by the way, if I'm hungry right now, I'll pick up my phone and I'll order Uber Eats and I'll have it here in 5 minutes. Okay, that was impossible, you know, 10 years ago. So this is what's happening. That's the these are the companies. And established tech has led this. So we're talking Apple, we're talking Amazon, we're talking Google. We're basically talking FANG. We're talking Facebook, and to a certain extent Netflix and some of the others, right? More recently, sustainable transport. We're talking Tesla. We're talking, you know, some of the other things. And then of course now it goes to the next level. So I'd like to talk about what I'm super excited about, but I don't know if you want me to. Maybe we'll talk about that after. So
that's good. Go for it. I mean, I'm curious, and you know, one of the questions that I want to get to is how you are talking about this to your investors, like to your clients, because I often use this term conversational alpha. Really, what disruptive innovation is all about. It's very different than talking about the yield curve or talking about a quality dividend strategy. You can talk to them, like in the case of cybersecurity, you can talk to them about the emails that they keep getting from a financial institution that they don't bank with, asking them to click on the link to verify. They've seen it. You can talk to them about the electrification of the car. You can talk to them about their credit card bill, where they see how much money their kids spending on video games or e-gaming. These are all things that are highly relatable. Which I want to get your perspective on how you actually integrate that into your conversations with clients about that area, and then you know, keep going with that, and then you know, go ahead and talk about what are the areas that really excite you the most as well.
Yeah, so that's awesome. So I think the biggest mistake we make as advisors, as portfolio managers, is we try and talk a financial language to clients that does not resonate. So it's pretty simple. You have to explain things in it. First of all, you have to have a clear belief. If you're a PM and you have no clear belief, you have no business running money. That's number one. Let's make that clear. Now, you can borrow strategies from the industry and you can hide in certain dividend strategies. And I'm not saying, you know, that's not okay. That's fine, right? What I'm saying is the belief will drive everything. So whether you're building products like you are, so people can invest in these beliefs, or you're building portfolios so that they can achieve greater returns over time, which is what we're doing. So those beliefs have to be engraved. So number one, you know, we don't want to talk financial things. We don't want to talk big picture. So it goes back to a book I read before I started in the industry, One Up on Wall Street by Peter Lynch. Peter Lynch was a prolific fund manager with Fidelity, okay? And so he had some of the best returns ever. And it was very simple. Anything he invested, he was a growth manager, and anything he invested in, he said, open your eyes. Look around. Look at what your wife's buying. Look what your kids are buying. Look at what you're using. Raj, you just mentioned, you know, cybersecurity. How many times did my mom tell me, I think I clicked on something. I don't know. I shouldn't have done that. Like
Yeah.
It's like the 17th time she calls me about this.
Yeah.
But this is a problem. So
Yeah.
if you know that you're gonna, you're subject to this, and you know it's an issue, and you know that it's something that we're using and we need to use to protect ourselves, then you need to be investing in cloud and cybersecurity, because that is an area that is growing right now, right? Same thing with what you're using on a daily basis. If you're streaming at home more and more, which most people did. Okay, the pandemic accelerated things, but we're using, streaming services for music, for movies, for everything, and you're watching less and less of the traditional, cord-cutting broadcasters. I don't
Mm-hmm.
need to mention who they are. Then we
Mm-hmm.
both know that as an investor, you should be investing in the things you're using more of and getting rid of the things you're using less of. It's very clear, okay? Same thing goes for the way we're buying cars these days, or the way we're gonna, choose how to move around, right? If we're using more and more services through AI, well, then we should be investing in those things, right? So same thing with the way we're buying our products. And so all of that is invest in invest in what's growing and what you
It's
see.
all about relatability. You
Exactly.
need to
So
be able to relate to it. I 100% agree with you. And One Up on Wall Street is one of the best books. And Peter Lynch called it. You're right. I remember, you're talking, go to Walmart and see what everybody's buying, see what's empty on the shelves, things like
and
that. And,
this
those
was
are
in the
products to buy.
80s. This was
This
in
was in
the
the
80s.
80s.
Okay. So this has nothing to do with technology. It just has to do with a belief. Okay.
That's
So
right.
so I
Yep.
wanna make that clear. And so if we believe we're in a technological renaissance, which we do believe, that's how we're basing our decisions, and we've been well compensated for it, by the way. So I guess our belief
Mm-hmm.
is somewhat correct, because we're not losing money because of it. We're gaining a lot of returns because of it. So then we have to invest accordingly. The epicenter, or the core of the portfolio, has to be focused on those generational trends and beliefs, right? And then everything around it, sure, you have to portfolio manage, and you can trade, and you can buy, and you can sell based on valuation. That is fine. But if that core of the portfolio doesn't have that, if you can't do it yourself, if you can't hire a team like ours, and then at least use ETFs to do it. And that's what I tell people. So we're using ETFs within that. But if you're a home gamer and you want to do it yourself, then don't try and pick the best cybersecurity company. Buy the ETF that has them all. Okay.
Yeah.
So and that's where I can be your advocate, because I know that emotional decisions are made, and let's be honest, humans are flawed. Humans make terrible decisions. They make emotional decisions, not based on facts, but based on how they feel, right? And so we want to avoid that. In our business, that is a no-no, and running money, that is a no-no. So definitely use facts to make those decisions.
So are you, and you still haven't gotten to the disruptive technologies that are your favorite yet, that you find are interesting, but are you finding that when you're having this type of conversation with your clients, that they have a higher level of education as it relates to these areas? Or are you finding that you are the educator of this?
So they know all this stuff. We're lucky because our client base is over half of them are entrepreneurs, and a big cohort of those entrepreneurs are tech entrepreneurs. I remember
Okay.
I mentioned that I started during the dot-com boom. I was lucky enough to start managing money for some of the tech entrepreneurs, the Godfather entrepreneurs, and through that network, I built understanding of that network. I have good friends that have referred me to other friends, and then before you know it, you have a cohort of kind of tech and telecom entrepreneurs that that trust you, and so that's the niche we have. So yes, when I speak to them, it resonates, but at the same time, we're mostly educating, because people think of investing as they still think it as a commoditized thing, right? Where it's like, okay, I got to get out at a certain time, and I have to try and time it at a certain time, and I don't trust this, so I better not take a lot of risk. But really, investing is not that. Investing is, you really want to try and grow over time, right? And you want to
Yeah.
invest in what you believe, so you get bigger returns. If I had to go back in time, it took me a good 5-6 years to. By the way, I've made mistakes. That's how I learned, and I knew this style of investing was the best. But because I was afraid, and I didn't have as much experience, and I wasn't as weathered, I wasn't as I didn't have the kind of acumen. So that took time to develop. So I always tell people, I made mistakes for you. So now we know what works, right? We've documented those mistakes. We're not going to go back and make the same mistakes. And we're all constantly making those processes and that methodology better, right? So I have a bunch of webcasts about this, and I've written about this in our blogs. It's all about, you know, not repeating those mistakes, right? Anyways, I think we were talking about how we educate, and so education is a big part of what we do, and that comes through in the belief as well. You have to have, like I said before, a belief of what you're doing and how you're doing it, and then you can educate, and people will you know, get better and be better investors, which is our why. You know, make everybody a better investor.
So I saw a stat a while ago that said that the average Canadian has less than 2% exposure to disruptive technology within their portfolio. I think it's probably difficult to actually put that stat because it also depends on how you clearly define disruptive tech. But that is way too little compared to what the relative expected growth is going to be of that area of the market. And also, you can't pigeonhole, right? I mean, somebody that's 75 years old is not going to have the same percentage in disruptive tech as somebody that's 35 years old. We know that. But is that a lot lower than what you look at for your clients' portfolios?
Yeah, so our portfolios don't look like
Yeah.
that at all. But I can't say it's all, right? So there's also cycles, right? So you go through these shorter term periods like we've seen now in the last 2 months, where anything that has a higher multiple has a very difficult time. That is the mechanics of money management. It's the fashion show of Wall Street, where certain things get out of favor and then come back in favor. And that's all part of the working arounds of having a methodology of trimming and buying and trimming and buying. And that's what we do, right? But having exposure to that is definitely in our portfolio. So it may not be 50% like last year, or 30 or 40%. It may be closer to 15 to 20% now in emerging kind of themes, just because, you know, the market at this point doesn't reward you for being in these themes as much, because we've made a lot last year for being in these themes. So what I'm trying to say is you manage the size of that. That's our kind of like secondary thing, is to manage the risk we're taking, right? When we're going after, or we're trying to invest long term in these things. But we know they're going to work long term. It's just they won't go up in a straight line. You know, you get pullbacks. It's normal. It's like anything else. Apple, by the way, pulled back 1 million times before it became a $2 trillion company. So did Amazon. And if you want to, you know, compare this, there's no difference. Apple and Amazon were once emerging technologies, okay? And nobody wanted to touch them with a 10-foot pole. Had you done it very early on and you were steadfast, just like had you invested in Tesla, okay, very early on, you were rewarded. Now, there was a difficult period of holding, and sometimes you were cut in half by 50%. But it's being in those long term is always rewarded investors. It's, did you make emotional decisions, or did you make fact-based decisions to keep you in them? And did you right size those positions with methodology, buying more when they were down, selling when they were up? That is the key. That's how we have to keep clients in these long-term themes, because those are the best places to be long-term, right? And so we need to make sure there's a methodology around that.
So we're recording this in early April 2021. And the first few months of this year haven't been spectacular for disruptive tech. Maybe we've all gotten a little bit spoiled by 2020, 19, 18 returns. And, you know, we've obviously, as an ETF issuer, participated in it. And there's been a lot more volatility this so far this year. How are you managing that with clients right now?
Yeah, that's a great question. So we just like, I mean, I'm sure some of your ETFs, we've come off one of our strongest years ever, which is counterintuitive given the fact that we've just gone through one of the worst pandemics of our time. But there's a few reasons for that. It's mostly methodology. Let's be clear, we're not taking outsized risk. If anything, our portfolio, the metrics in our portfolio are less risky than the indexes by a wide margin. But it's because we had that in the core of the portfolio. So we were able to, you know, when everything was down, we were able to double down on our bets calmly because we knew what we were investing in, right? So that allowed us to have outsized returns. Fast forward to 2021, that's been done, right? So now we're looking at a portfolio that went up a lot. So now we had to rebalance the portfolio several times, and we've taken money off the table. But where do we allocate that new money, right? That is the big problem. And so we keep exposure to the areas we love, in the disruptive areas and the growing areas. but we're aware that the market is not rewarding those because it's going to be very difficult year over year for those companies to show the same kind of increase again this year, right? So maybe in 2-3 years, those companies will still be growing at 30-40%, but year over year, the big gain has been made. And because of COVID, a lot of those earnings were pulled forward. So into today versus being slowly but surely kind of like increasing over time. So now the market is rewarding reopening companies because those earnings will be expanding year over year versus last year. So it's just a rotation. And by the way, there are growth companies in the reopening trades as well, and some of the more traditional. It's growth in earnings and revenue. It doesn't mean that those companies are going to change our lives, but those are shorter term things. The generational companies are still going to grow. And as a matter of fact, it's going to accelerate. The only difference is right now, don't expect the same kind of return you got in 2020 because everything was pent up, right? So we needed to make those shifts quickly because of the situation we were in. Now you can expect a more normalized. And as a matter of fact, I'm quite happy that a lot of these companies and sectors have pulled back because now it gives us a chance to buy some of the greatest, companies on the planet. But we do it calmly, not at all-time highs, right? So that's interesting as well.
So I've got 2 more questions before we start closing up here and run out of time. The first is, you're an advisor. You've been doing this for a long time. Give us your views on the whole Reddit Wallstreetbets crowd out there. What are your thoughts?
Okay, so we didn't talk about bubbles. And so I will say a few things. There's things that get me nervous, and there's things that I love. So it doesn't get me nervous that we have a cohort of people that are investing and love it. By the way, if anything, I think it's amazing. I remember
it's democratizing investing.
It's democratizing investing. It's allowing people to do great things, to build wealth for themselves. Okay, and there's no other better wealth creator than investing in companies, investing in capitalism, and that's what I believe. Now, that's how I got into the investing is yes, I was interested in it at a young age, but in CEGEP, I remember in university, we were trading as well. We were calling in because we didn't, we were able to do it fast with our dial-up, modems and stuff.
Yeah.
But so we were trading. So I got a taste of that very early on, and I love it. What I don't love is I don't love the enthusiasm behind certain assets that I think where celebrities get behind. So there's a lot of I call it there's red flags. And so when I see a celebrity get behind an NFT or wants to do an NFT, and for the listeners, that's it's a piece of art backed by digital currency or just
non-fungible token.
Non-fungible token, that gets me nervous. So I can't be excited about those things. Just like I can't be as excited about Bitcoin when it's gone up as much as it has. I think it's here to stay. I just think that those are some of the things that get me nervous. I don't think Bitcoin gets me nervous. I think the NFT and everything around it gets me nervous. Some of the SPACs get me nervous because these are companies that don't have a lot of earnings. So I am excited about what I'm seeing. I don't like some of the bubbly areas because that's competing with great companies. And so money comes out of, let's say, a company growing earnings at 40% to go into some new company that has unproven earnings or some NFT. And I think that's dangerous. So just be wary. Don't get caught up in that. Eye on the prize if you're a long-term investor, and try and see beyond what those small bubbles. I don't think it's a big bubble. I just think it's some small bubbles here and there.
I agree. I think a lot of the traditional managers have really criticized the whole Reddit and Wallstreetbets movement. And, my view is 2 parts. One is the fact that I'm a big fan of democratizing investing. And I think that that's great. I don't agree with a lot of the companies that these investors are backing up the truck on, but that's what creates a market. I mean, that's the beauty of the environment that we're in. I don't need to agree. And, I learned a lesson a while ago that you shouldn't judge other people's decision-making process. It may not be the right decision for you, but it could very well be the right decision. And I've also recognized that younger investors look at things very different than older investors like myself do. And I've often said about NFTs, one of the reasons I believe that this could catch on, I don't know, is the fact that younger investors tend to look at things more in a more abstract way. and people like us tend to look at things more linearly and often more black and white, and it's tough. So I've got to give them. I can't criticize it. I've got to appreciate it.
And let's be clear, we're not disputing the NFTs. We're just disputing some of the valuations that are being,
Right.
these things are being sold at. I think there's absolutely a reason for it, and I believe in it, just like I believe in crypto, and I believe in a lot of things. I just don't know if the prices people are paying for things make a lot of sense, but that's okay because it's an investor's market, and so as long as it doesn't drag in, too many people, and then those things get evened out, I think then the world will kind of settle on a price that's fair, and it's up to you as an investor to decipher what's fair or not, right? So there's merit in all of it, and if you're dismissing it and you're dismissing any of that, I think you better be careful because you're going to be
don't be too
wrong.
close-minded. All right, before we close off, your favorite disruptive innovation areas to be investing in. We talked about it at the beginning. We never got to the list.
Yes. So I mentioned a bunch of them, but the one that I kind of feel really excited about, and we know how to invest in it, but we're not quite sure yet, is health tech. So there's a lot of antiquated industries that need to be disrupted. There's no question, and they're already being disrupted. We think healthcare generally has the biggest, let's call it TAM, or the biggest total addressable market, and we think that's the one that will feel the, let's call it the positive forces of disruption, not negative forces, positive forces. So for example, cures for cancer. It's AI will solve this. The next $1 trillion opportunity is going to be in this space, and that's how we feel. So I think health tech is huge.
When you say health tech, you're not putting biotech in there, or are you putting biotech in there? You're putting biotech, you're putting wearables, you're
everything.
putting telehealth.
I'm putting the whole
everything.
sector in there. I'm putting the way we take pills. So I'm saying that AI and data will, data is king, right? Data is, software will lead the world. That's what Peter Thiel said. So data is king. It's what you do with that data, right? So everybody has data. Nobody knows what to do with it. And so the companies that are able to create things from the data, obviously, and find faster paths to cures and find faster treatments, help us treat ourselves better instead of taking pills. Why don't we understand the physiology? I wear this Whoop. I'm wearing a Whoop right now, okay? And I have an Apple Watch. The reason why I wear these things is because, yes, one, I'm athletic. I like to get on my bike. It's my pastime. It's how I let loose. But it also allows me to track my sleep, understand what I'm putting into my body, what that's doing to my body, the stress. It's a personal coach. Now, could you imagine if we could take this data up a level, okay? And everybody can be hooked up, and we could be getting, information to increase the quality of our lives, the longevity of our lives, and to a certain extent, replace some of the pills that we're taking with other things, right? So we all know this. We all know this. Can we get to that point? I think health tech is, and I think Apple's a very old school way to play it because they're already starting to get in it. But there's better ways to play it. There's data, and
I think you're totally right. I love this space too. We've been exploring it for a while also, and I think one of the key elements to the advancements in healthcare through health tech is we will go from a prescriptive era to a predictive era, meaning that the AI, the wearables, all of these other tools are going to help us avoid the problem. So right now we just go to the doctor when we're sick, right? And so they prescribe us the pills or a procedure or something like that. That's when we're already sick. But where the next future of healthcare is going to be in preventative and preventative healthcare, which I think is going to be great. In fact, there was a great 60 Minutes story on this a few weeks ago, maybe 2 months ago. You lose track of time during COVID, but a couple months ago that said that any North American that's born today is going to live to the age of 103.
I agree.
It's nuts, right? And that's going to be primarily driven by the evolution of our healthcare system.
Absolutely.
More than anything else. And then you get into CRISPR, which we won't talk about right now, but that's also really interesting, where you can create designer babies and things like that. Anyway, sorry, that was one. Let's make sure that the next two are faster.
Companies like Invitae, right? DNA sequencing, like these No, we're talking about Kathy Wood's companies now, and I don't want to
Sure.
really promote the ARC fund. We're here to do other
No,
things.
that's okay. No, that's okay.
But no, these are absolutely just iceberg things, right?
By the way, the one thing always say about Kathy Wood, just when you mention her, is first of all, I'm a huge fan. I think she is a rock star, and I think that she has been phenomenal for the entire disruptive tech ETF market and the industry as a whole. And I believe that we, as a much smaller issuer than ARC, have been one of the beneficiaries of her putting disruptive tech into the spotlight. I mean, she's everywhere. Look, you've made it when there's T-shirts with your face on it.
Absolutely.
So anyway, sorry, the other two disruptive tech.
Well, I mean, you can't, for me, AI, cloud is those for sure.
Big ones.
So cloud, I mean, things have kind of slowed down a little bit, but so I like to think of 5G as the, if, 5G is all about connecting, devices, right? So when a good example is, we consume content, we used to have to load videos. We'd have to click on the video, it'd have to load. Now you just open it, the video is already going, it's going. So that's enabled by we call that edge cloud computing, right?
Yeah.
So now we're getting to the next level. And people are like, oh, that's done, cloud is done, everybody's invested in cloud. Not even close. Not even close. As a matter of fact, we've just started investing in cloud. I could think of maybe the large corporations have started to, they use Salesforce or they use whatever. We're not even close. So there's so much more we
totally
can
agree.
do. There is so much more we can do.
There is. In fact, there's only 40% of our data is in the cloud. We still have a long way to go. But I mean, when we launched a cloud computing fund a few months ago, and we had advisors say, "Well, haven't we really missed that trade?" And the answer is no. It's still very early innings in the space. Part of the reason why it's so early innings, I mean, your firm has been one of the leaders in embracing technology within the financial services industry. But I mean, one of the challenges for a lot of others is they have these legacy systems that they cannot modernize to cloud computing, and that's where the opportunity represents itself as a great area to be invested in. So we're on the same page.
And AI. So when I say AI, I mean like
AI is everything.
So if we think about sustainable transport, driverless cars, I mean, that will change everything. Like you don't need, I mean, I don't want to disrespect anybody who runs a cash register or who drives a truck, but really those people, we can do, like they can do more. They can work in healthcare, they can work in societal things. I don't know. They can run the government better than the government's running themselves right now. So what I'm saying is this keeps inflation, by the way, low. They say we're in an inflationary environment. I don't know about that. So yes, we are to a certain extent, but at the same time, technology enables everything to be better, faster, and with less expense, right? That's the key. And so all of this is coming. And so I like companies like Uber because that could end up being an Uber everything, and it doesn't even need these contract drivers anymore because we can get robots, we get computers to drive them. The cars can drive themselves. So don't underestimate the power of what this can do for our society. Okay, so including in our business. So I think that's don't lose sight of that.
AI is everywhere. I mean, AI is being utilized by so many companies. I mean, within cybersecurity for preventative threat measurement, within, as you said, the automobile sector. I mean, AI has become. I mean, if you bought a car in the last couple of years, it's the most sophisticated piece of technological equipment that you own, right?
Yeah.
And over 1 million lines of code going into a car today. So I totally agree. It's a great area. The challenge, I think, for AI, just before we close off, in my opinion, is the investable universe is tough to access because AI is part of a lot of technology companies, but there's not a big universe of AI listed companies, if you know what I mean. And because we've explored it a bunch of times to look at creating an AI ETF. That's a tongue twister, and it's not easy to find a public company that's just focused on AI. You had a big one.
It'll be 50% Google, so it'll be companies
because they're all using it. They're all using it. Anyways, this was great, Robert. I really appreciate it. We're gonna have to do a part 2 because I had a bunch more questions. So we'll pick this up another time. But appreciate it. Really, congrats on all your success and stay safe. and wish you continued success.
Thanks, Raj. Really appreciate being on.
Thanks, Robert.
Thank you for listening to the Evolve ETFs podcast. If you like this podcast, please like this post. Subscribe to this channel by clicking on the subscribe button. Ensure to sign up for our newsletter by visiting our website, evolveetfs.com.
You have been listening to the Innovators Behind Disruption, a podcast series brought to you by Evolve ETFs. Remain educated. Be informed. Sign up for our newsletter and learn more at evolveetfs.com.